Hello and welcome to Dukascopy TV. I'm Andrew Saks-McLeod from LeapRate, and this is the Forex Industry Talk Show. And today I'm joined by Tom Higgins, CEO and founder of Goldeye. Hello Tom, nice to see you.
Hello, nice to see you again.
And Marc Spaelti, Chief Operating Officer of Dukascopy Bank in Switzerland. Hi Marc, nice to see you.
Hey, good afternoon. Good to see you.
So today we're going to talk about the current discussion among the industry worldwide, it seems, is it looks to me as though many industry executives are looking at the possibility of taking retail FX onto exchanges, which you and I spoke about this a year ago or so, and there was no talk of this. And really we were looking at the possibilities of it happening. And I think we both concluded that at the time it was more likely to be an exchange type model that might be adopted, or even a banking system. But now there's some talk of exchanges, so I'd like to go into that a little bit if I can.
Yeah, I've got quite a lot of experience in exchanges because in fact, I started my career in exchanges. My first job was at the International Petroleum Exchange, where I was automated the trading floor, or all of the work on the trading floor, and then eventually replaced the trading floor with an automated system. So I got to see how an exchange worked. And because I'd never worked at a broker, I had the feeling that exchanges were wonderful places that everybody loved and brokers loved them, and they provided a really efficient and effective place to trade. When I then moved on in later life, after having worked at the Futures Exchange, and moved to brokers, I realised that actually it was a bit of a different story, and that brokers saw that exchanges were very expensive, somewhat efficient, but they didn't add to an OTC market that had huge amounts of liquidity. And that view has held for a very, very long time. But I think, as Andrew says, with the SMB happening and the fragmentation in the market, certain parts of the world, now maybe Switzerland doesn't cover because every broker has to be a bank and liquidity providers are all banks, but with lots of non-bank LPs, it's very fragmented. And the idea of a central exchange model, if it was cost effective and really was efficient, has some merit in my view.
Well, I'm of course coming a bit from the other side, being in investment banking, having a background trading FX spot over the counter for years. I quite like the diversification that we have currently, with each bank basically free of quoting its own price to its clients, suited to its clients. I see some problems, of course, that the FX market is being a global market. They will have a problem. Where do you want to place this exchange? You'll also have maybe a problem of size. FX market, thinking of euro dollar, where trillions are traded every day. I'm not really sure an exchange could so easily handle that. And then, of course, there's also the question of fees and who's actually going to be owning this exchange.
Well, that's the thing, isn't it? The fees are huge. If you want to go and be a market maker on CME, it's going to cost you millions. And this is not possible to capitalize this under the current model of retail Forex, because the spread and the commissions that can be charged to an external customer are not high enough. However, what if there is an exchange type model that's invoked, which is away from the actual physical venues, is an electronic venue, and is a kind of system rather like now you have Fast Match introduced the OTC exchange. It's called I think it's actually called OTC exchange, which is an electronic exchange which doesn't have a physical venue, has very, very low fees, but will operate as a kind of central exchange between liquidity taker and liquidity provider.
As a bilateral market.
Yes.
Yeah, the bilateral, that goes halfway, because it gives you a central execution point, but you still have counterparty risk because you still are bilateral trading. Where you're then introducing a clearinghouse, you then take away that bilateral trading because you're novating all of your trades into the central clearing party that becomes party to your trade.
Yes, obviously eventually you'll have a risk to the clearinghouse if you have too many clients defaulting or too many counterparties that may default because they had a large exposure. You may get a chain reaction of default where all of a sudden the whole clearinghouse gets in trouble, and then you don't have any more exchange possible because you're deprived of the way of dealing directly with another counterparty.
That's very true. And of course, when a clearinghouse models its risk management, I very much doubt it models a 30% move as you had with the SMB. They would model a smaller size and say that maybe the maximum you'd ever get is 5% or 10% in a Eurodollar. But so that maybe they would have, if it had been a central counterparty, maybe it would have been a systemic failure in that case, rather than a short few hour failure and then the system rebooted and recovered
that's
itself.
The thing, isn't it? It could be that. It could be like exactly as Tom says. It could be a systemic failure, or it could be that if let's say over the last year there's been a lot of complacency among OTC brokers where they've not kept. There's been low volatility. This was something which has been highlighted by many big exchanges like NASDAQ and CME. They've vocally spoken about the fact that there's been low volatility, and the OTC providers have kept very little funds to cover any negative balances should they come back if they are booking the trades. Then along comes the SNB situation, January. There's a massive exposure straight away to negative balances because they're going straight to the brokerage. If there was an exchange in the middle, yes, the broker may have had to pay some exchange fees, but there would be an identical default fund for each particular one, which would, even if it wasn't quite enough, it would mitigate the damage and then create a situation where a broker would have much longer time to fix the problem than to have to react immediately to it straight away, or even worse, go out of business.
I can agree with that. I can agree that the individual counterparty will have a better protection against, today obviously each counterparty has to assess his client's credit risk and their counterparty's credit risk, etc. Having, in fact, quite a big infrastructure to maintain that, to analyze that, etc. This, of course, could be centralized by the market if it's only one person doing it. There may also be an advantage that, still in the same go, that now if you have that default, you don't immediately default, as you said, because you have the exchange. There's some kind of emergency fund or a default fund that will kick in and at least help protect your client's fund.
Yes, and the broker has to lodge that with the exchange in the outset. Is that right? They have to actually.
They do.
When they become an exchange clearing member and an actual member of the exchange, which I think are two separate.
They don't have to become an exchange member. They would. Most people are trading through an exchange member. They wouldn't necessarily be a member themselves because it is very expensive. The member lodges it,
and then the market maker becomes a market maker on the exchange that trades through the clearing member.
Absolutely.
But I have flash ideas sometimes. I have little sparks of innovation, which is where I invent my products, and they're normally in the shower. So I'll normally be in the shower and I'll suddenly think, aha, I've just invented something, and then I rush to work, write it down, have a quick meeting, and we see whether it's got any legs, see whether it's any good. And so we're launching a new aggregation system called Gold Eye Matrix soon. And then I was in the shower thinking, how can we, if we had 50 brokers who bought the system, they're all operating independently, how could we somehow leverage the fact that all of these people are using the same technology? And so I thought of something which in my head I called Matrix Net. So you'd connect them all together. So if one of them had one asset class that other people wanted to trade, they would be able to route it through a central place. But then I thought, well, actually, what I'm talking about there is just an exchange. So everybody routing their orders to a central place, some people with different asset classes than other ones, and going to a central place where the exchange becomes then more an operator, a technology operator for a bunch of people, rather than a marketplace in that sense.
So can that be hosted without a physical presence? I mean, if you look at this,
absolutely.
Here we have a depiction of a very early manual exchange, which was labour intensive and very inefficient. You have several exchange traders that turn up for work each day, and this was how it used to work. This particular model that you mentioned could potentially be no overheads, no staff, no physical presence, and actually be hosted somewhere.
Well, you would need staff because you have to oversee a market. Because if you look at what happened with the HFT trading in the States, you had a multitude of exchanges all connected together with a central regulatory body trying to control it. And where they thought they were creating a fair market, actually what they created was an opportunity for the high frequency traders to get in and front run the clients. So all the investors got slipped on every single order. There's a fascinating book, Flash Boys, and I thoroughly recommend reading it if you haven't been able to read it yet. And it explains how the HFT market was set up and why people want such incredibly tiny latency to the exchange, because they can exploit any tiny opportunity. It's the same in the FX world with snipers, they're getting a slightly better price than someone else, and they can get in there quickly and see the change.
At the same time, you have to add that a lot of those high-frequency players have come in because they had some big investment in the back. They designed their model, they came in, they started trading, and some months later realized that the idea might have been good, but it didn't really work out, and then pulled back out.
Yes, that's true. Yeah.
So this opens a whole new thing where latency arbitrage could become something which is very much the focus of retail Forex, because if you've got an exchange, then the HFT institutional prop shops may start to be able to, that particular high frequency model may not just become the preserve of Chicago and New York. It could be you, me, and everybody else at home doing it through an exchange, through a virtual exchange.
I think you would end up needing a distributed model, so whereby we've got virtual hubs in London, Tokyo, and New York, in NY4, LD4, and TY3 data centers, the place you go to trade. I think if you had a smaller exchange at each one, there's no reason that you would need to actually feed orders between, as you do in the equities markets, because there's enough liquidity to have them separate.
Much more liquid.
So you wouldn't need to take all of the orders going to New York and send them to London. You might want to do that as a broker, but there would be no need to do that.
Yeah.
With a small risk, of course, that there will be arbitrage between those exchanges if there is a time lag, a problem in timing, or if certain orders don't get routed right. And there's also quite a lot of technology issues, but that may actually be another subject.
And of course, the other problem with an exchange has always been the charges. So by charging for data and charging for exchange fees and charging for clearing, I think if they applied the same charges they apply in futures, we wouldn't have a retail market, because it would be too expensive. So they would.
I agree. I think the cost for the end client will go up with that.
So they would have to have a model which was more efficient and didn't require those sort of costs. And I can't see with modern technology that isn't possible.
I think that's absolutely right. I think we should certainly take a close look at that in the next episode, by all means, because that's reducing the cost via the modern technology with less physical presence in certain sectors is certainly very interesting indeed. So let's look at that next time. Thank you very much for joining me, Marc Spaelti, COO of Dukascopy Bank, and Tom Higgins, CEO and founder of Goldeye.
Thank you.
See you next time.
Thank you.
Thank you.
Yeah,
See you next time.
again.
I'm Andrew Saks-McLeod from Leap Rate. This is Dukascopy TV. Thank you for watching the Forex Industry Talk Show. See you soon. Goodbye.